Hello students, a warm welcome to all of them. I hope you all are doing good and fine. As in a previous session, we had completed the chapter number 2, that was investment income. And in our today's class, we will be starting with a new chapter, that is chapter number 3, property income. In this chapter, we will be dealing with the rental income which we earn through our property by letting it out. So, in this chapter, we will be covering the rental income, what are the expenses that are allowed to be deducted under the property income so that we arrive to our net income. So, starting with this, as we know that the property income lies under the head of non-saving income, and in our saving income and dividend income, we learned that both of these are taxed on the cash basis, that is when we receive it, whether it relates to previous year or future year. Saving income and dividend income will be taxed on when we receive, in the tax year which we receive, whether it relates to previous year or any other period. Cash basis means whenever we receive it, we will be taxing in that tax year. When it comes to the non-saving income, we had many types of non-saving income: trading income, property income, employment income, pension income. So these types of incomes, the non-saving income, we did not study whether they will be taxed on cash basis and accrual basis. So your concept on cash basis and accrual basis needs to be clear, because cash basis and accrual are the concept which would have covered in your F3 paper, that is financial accounting paper. Before that, I would give a short brief on this. Cash basis means whatever cash you receive in the period, in the tax year or in the accounting period. What cash basis means, you are receiving it. Accrual basis means whether you are receiving or not, it will be your income. Example, I am selling my goods, sale of goods to a customer. I still did not receive my payment as I have given it for on credit. When I receive my payment, this will be my cash receipt. So cash basis means whenever you receive the cash, in that year you will be taxing it, or in that year you will account for it under the accounting rules. Under the taxation means when you receive it, accounting rules means whenever you receive it. But the accounting rule run on accrual basis. What does the accrual basis say? Whether you receive your payment or not, but whenever you sell your item, whenever you sell your goods or services, it is an income for you. Whether you receive your payment after 2 days, 10 days, 30 days, 40 days, does not matter. So the difference between cash basis and accrual basis is that cash basis means when you receive your receipt, accrual basis means whether you receive your receipt or not, it will be your income for that year. So dealing with these cash and accrual basis in the tax, in the tax we will be seeing this as dividend and saving income are taxed on cash basis, that is when you receive in that tax year you will be taxing it. So for non-saving income under the head of property income, how we will be taxing it, whether on accrual or cash basis, because saving and dividend income we have seen as per their particular heads. But when coming to the non-saving income, we had 4 to 5 types of incomes: trading income, employment income, pension income and property income. For these 4, that is trading, property, employment and pension income, we will be dealing with each chapter for these 4 heads, so that you will get a clear idea whether to tax on accrual basis or whether to tax on the cash basis. Now starting with our today's chapter, that is property income. The property income will be taxed under cash basis. This is the default basis. Accrual basis will only be followed if certain rules are satisfied, or if the examiner in the question mentions to follow the accrual basis. So we will be covering this in our next slide. So what are the learning objectives we will be learning in this? What are the content we will be learning? The learning objective of this chapter: compute property business profits, explain the treatment of furnished holiday lettings, what are the conditions that converts a property into furnished holiday lettings, understand a rent a room relief. What is rent a room relief? In your house, you are owning a house and in your house you have 10 rooms, and in these 10 rooms you are letting out 1 to 2 rooms, those rooms are not useful to you. So this, how it will be taxed, will be learning that also. Compute the amount assessable when a premium is received for a grant of short lease. So the premium, what is premium? Premium, lease premium. The lease premium which you will be receiving, how you will be taxing it. Lease premium is different from the rent which you receive. Rent is paid each month, but lease premium is an amount which is paid above the rent. It is a premium amount. Understand and apply the restriction on the property income finance cost. How the finance cost will be treated under the property income head. If you are taking any loan and on that loan the finance cost is involved, how you will be treating that finance cost. Understand how relief for property business loss is given. Property business losses relief, how it is given, we will be learning that also. So in our today's class we will be completing the property income chapter, and in that property income chapter we will be learning these 6 key topics. These 6 topics are very small, and each topic is very important, as you can get 2 marks OT questions, or in your section C for 4 to 5 marks you can get a part to solve the property income. So moving with our next slide, we will be looking to the property income. Property income basis of assessment. How the property income will be assessed in the tax year. The property income assessed for an individual or partnership in a tax year is the income less expenses actually arising in the tax year. So how you will calculate your property income? Whatever is your income less your expenses arising in that tax year. For the tax year 23-24, the net income rising in the period for 6th April 2023 to 5th April 2024, as this is your tax year of 23-24. So how you will calculate your property income? Property income less expenses which relates to that tax year. So by calculating this you will get your property income. The method used to calculate the assessable income rising in the tax year is normally the cash basis, as earlier mentioned by me in the introduction, that as saving and dividend income are taxed on received basis, then when they are received they are taxed in that tax year. So when coming to the non-saving income head, we have many types of income. When coming especially to the property income head, we will be taxing the property income defaultly on the cash basis. What does cash basis means? Cash basis means accounted for when cash is received and cash is paid, but is in certain circumstances the accrual basis will be used. There are certain rules to be filled in order to follow the accrual basis, but the default basis is cash basis. Cash basis means whatever is the cash you have received in the tax year and the cash you paid for the expenses will give rise to your assessable income. Will give rise to your assessable income. Cash received, whether the cash or the rental income you have received, whether it relates to previous year rent you are receiving current year, that will be your current year income and will be taxed according to the current year under the current year head. So, and the cash paid, whether the expenses which you are paying, whether it relates to previous year or future, it will be deducted in the current year as cash is going out. If landlord lets more than one property, the assessable amount for each tax year is the aggregate of the net income for all properties, excluding or except furnished holiday letting. What does this point say is that as a landlord, if I am a landlord in UK, I have 2 to 3 properties, then when I am taxing my income tax calculation that time, I need to aggregate the property income of all the property together in order to get my net income, aggregate of all net income of all the properties. So for each property I will be calculating my property income separately. Property 1 cash basis, property 2, property 3. But when you are filing your income tax return, you need to combine all the properties, the net income or the assessable income of property 1, property 2 and property 3. So the fourth statement the examiner says is very important. The examining team has stated that in an examination question involving property income for individuals or partnership, The cash basis should be used unless specifically stated to the contrary. So under the calculation of your property income, the property income must be calculated under the default basis, that is cash basis, as if nothing is mentioned. Accrual basis, when you use it, if the examination questions, or if the examiner states you that you need to calculate the property income according to the accrual basis, at that time you will be calculating your property income according to the accrual basis. If not, default method is cash basis. Clear with the concept of accrual and cash basis. And the property income will be calculated under the cash basis. Accrual basis will be followed if the examining question states you particularly, or if the rules are satisfied. Mostly in the exam they will say you whether you need to calculate on the cash basis or accrual. If nothing is mentioned, calculate it on the cash basis. If it is mentioned that accrual basis, then do the calculation according to the accrual basis. Now we will be further studying how to calculate the property income under the cash basis and under the accrual basis. Cash received, and so under the cash basis you will be saying it is cash received, but when it comes to accrual basis, what you will be saying? Cash receivable or amount receivable, means amount receivable, because accrual basis means whether you receive or not, you are letting it and you are earning income. The tenant will pay you after 1 year, but you are letting it today. He is using your property today, so you will earn your income in that period. So accrual basis and cash basis has a huge difference, and the way of calculation is very different, because the expenses which are allowed in the cash basis and accrual basis are very different. We will be further seeing in our slide. So property income is calculated on default basis, cash basis. If it is mentioned, then you will be going with your accrual basis to calculate your property income. So cash basis. The cash basis is the default basis for individuals and partnership to calculate assessable income from land and building each tax year. Each tax year you need to calculate the property income under the cash basis. It is calculated as rental income received, that is amount you receive, less related expenses paid, you will be getting the assessable income. So rental income received, whatever cash you received in the tax year, that is 6th April 2023 to 5th April 2024. Within this period, in this period, whatever cash amount you receive, the rental income, that will be your income, and whatever cash you paid as an expense, that will be your expenses. By reducing your expenses, you will be getting your assessable income. For each property you will be doing this differently. Property 1, property 2, property 3. When you are filing your income tax return, you need to aggregate the income of all the 3 properties. The rental income and related expenses are assessable, deductible on a received and paid basis. Accordingly, the period to which the income or expenses relate is irrelevant. In which case it is irrelevant? It is irrelevant in cash basis, because under the cash basis we see that whatever is the amount we receive, whatever the amount goes out of our hand, amount come in, amount go out, is net income. Because in that case, then the income or expenses which relate to which period is irrelevant. The period which to the income and expenses relate is irrelevant under the cash basis. But when coming to the accrual basis, the income and expenses which relates to the period are relevant. For example, I am letting my property from 6th April 2023 to 5th April 2024, but the tenant has paid me the rent of £10,000 on 10th April 2024. Now under the tax basis, under the cash basis, the £10,000 when will be taxed? In the tax year of next tax year, that is 24-25, because you have not received this amount in current tax year, but it is pertaining, it is this year's income, it is this year's income, but it will be taxed under the next year, because under the cash basis when we receive, we will be taxing it. The period which to which the income or expenses relate is irrelevant. If we take the same example for accrual basis, then the 10,000 will be taxed under which year? It will be taxed under 23-24, as the 10,000 income relates to the tax year 23-24. So cash basis is the default basis. What is the amount we receive? What is the amount we paid? Give rise to our assessable income. So now further we will be studying what are the expenses that are allowed. Means what are the expenses which can be reduced from our income. So moving to the further slide, property income, cash basis allowable deduction. As mentioned by me, cash basis and accrual basis allowable deduction are very different. So first we will be learning with the cash basis, then we will be moving to the accrual basis. So coming under the cash basis, before that you need to clear one concept, that is capital expenditure and revenue expense. This you would have covered in your, excuse me, you would have covered in your F3 expenditure. What does capital expenditure and revenue expenditure? From the word only we can identify what is capital, which enhances the value of an asset. Like I have a building. Now the building is of 4 floors. Now I am further investing money and building one more floor. So my total number of floors will be 5. So the amount which is invested in order to enhance the value of the building, or which increases our earning. Now for 4 floors I will be getting some amount of rent, but if I build one more floor I will be getting further rent. So the increase in the income from a building or from a property by investing some amount, that is known as capital expenditure. The expenditure which is done in order to enhance the value of the building or to generate more income, that is known as capital expenditure. When it comes to revenue expenditure are those types of income which are expensed or which are incurred on the building in order to maintain the income. Example, I have a building and of 4 floors, but I am incurring an expenditure to repaint my building. So this will be what type of expenditure? This will be a revenue expenditure. Why? Because by doing capital expenditure, I will not increase my revenue from that property. No, I am doing this expenditure. This expenditure will not help me to increase my revenue. But the capital expenditure which I have done to increase one floor or further build my property will give me further income. But the expenditure of or painting will not help to increase my income. If anything expenditure you are doing on any asset, if they are helping you to earn further income, they are increasing your income, then it will be a capital expenditure. If they are helping, the expenditure are helping or are such of nature such that the income is of the same level, then it will be an revenue expenditure. Clear with this? Revenue expenditure and capital expenditure. So these 2 points are very important, as this will help for your further understanding of your expenditures which are allowed or disallowed under the property income. So property income. Under the property income, under the cash basis, keep a simple point that we have 2 types of expenditure: capital expenditure and revenue expenditure. Revenue expenditure will be an allowed expenses, capital expenditure will be disallowed, means it will not be reduced from your income. Capital and revenue allowed, and this is disallowed. So, and the income. So what are all the expenses which can be allowed? Revenue expenditure is allowed, capital expenditure is not allowed. So I'll give an example why the revenue expenditure and capital expenditure will not be allowed or disallowed. So what the property income under the cash basis says, whatever expenditure you are doing, that must be wholly and necessarily incurred for the purpose of the property business. To do that property business, you are wholly and exclusively incurring those expenses for running the business. Wholly means particularly to that property. Property 1 means property 1, whatever expenses you are incurred, you will reduce from that. Property 2 means from property to income. Exclusively means for that property only. Wholly means from 1 lakh you are spending for 50,000 property 1, then property 2 50,000. You can't reduce the whole 1 lakh pounds from 100,000 pounds from property 1. You need to reduce from 50-50 from property 1 and property 2. So the general rule is that to allow is the expenses must be incurred wholly and exclusively for the purpose of for the business property. This covers items such as insurance, agent fees and other management expenses, and repairs come under the revenue expenditure because this will not allow to increase our earning capacity. Insurance, agent fees means before letting my property I am hiring some agent that you find some customer, so for them also we are paying the fees, that amount will be reduced. And the interest on loan to acquire or improve a let non-residential property. And however, there are special rules which apply to financing cost of residential property. So as mentioned in the learning objective, understand and apply the restriction on the property income finance cost. As I told that we will be learning how the finance cost will be dealt. So there are two types of property: residential property and non-residential property. For residential property, we have some special rules. For the non-residential property, whatever is the finance cost will be reduced from the property income. See, they have told, because this whatever the interest cost, whatever is the finance cost is particularly for running your property, to run your property business, so it will be reduced from your property income. But when it comes to the case of residential property, we have some special rules. So these special rules are as same as the example of the personal allowances. So for married couples, in the chapter number 2, we have seen that the personal allowance of one person or the married couples can be transferred. The person who is transferring the personal allowance, his personal allowance will be reduced, but the person or a spouse or civil partner who is receiving the personal allowance can't increase the personal allowance amount, because personal allowance is a fixed amount. How they will get the relief? They will be getting a relief at a basic rate of 20%. What was the transfer personal allowance amount? 1260. What was the relief they used to get? 252. So this 252 will be this 252 will be this 252 will be reduced from the income tax liability of that individual who is receiving the personal. Clear with this we have already dealt with our chapter number 2. The same type of tax relief applies to the residential property. Which property? Residential property. This rule applies to the PA rule applies same, the PA tax relief rule same applies to the residential property. We'll be further covering in our next slide. So what is the general rule? What expenses are allowed? The expenses which are paid in cash in the year, whether it relates to previous year or future years, but wholly and exclusively for the purpose of property business. Example are insurance, agent fees, other management expenses, repairs. When it comes to interest, we have the different rules for non-residential property and residential property. For residential property, we will be further covering the rules. That is, the relief will be provided in the same way as the person or the married couple when they transfer their marriage allowance. That is, when no marriage allowance, when they claim the marriage allowance. What is marriage allowance? That is, they can transfer the personal from one partner to another partner. For in the case of non-residential property, whatever is the finance cost, it will be reduced from the property income. So the relief is available for any expenditure incurred before letting commenced under the normal pre-trading expenditure rule. See chapter number 7. So what does this rule say in chapter number 7 is that I'll give. This rule says, now you are letting your property from 1st April. But before letting the property and before starting your property and building your property, you had incurred some expenditure relating to your property business. Like you had hired a person to do some research, where we need to you hired an individual to do some research. What research? In which area I need to acquire the property? In which area I'll be getting a higher yield? So whatever expenditure you are incurred wholly for running the business property, whether you paid now, but your property income will be starting, and you'll start to let out your property income after 2 years, because for the 2 years you will be incurring the expense to build or construct it. How this amount will be allowed? The expenses which are incurred before letting the property are allowed to be reduced from your property income when you receive the property income. Clear with this? What does the word pre-trading means? Before letting your property, you incurred some expenses. That expenses are allowed when you let your property and you start earning an income. Whether it was paid previous year only, it was paid previously, but at that time when you previously paid this would not be an allowed expenses. And for the taxation, so you would have faced an loss, because you would pay an income tax more. But what you can do, the pre-trading expenses which you already paid, the pre-expenses which you already paid before letting your property, you can reduce when you receive your property income and the year in which you tax your property income. Clear with this? Now we'll be moving forward with our other rules. The first rule was general, wholly and exclusively for property purpose. The second rule was whatever expenses you have done before letting your property, that can also be reduced. So this is a special rule. If the property is acquired for part of the year by the owner, any expenses relating to private use are not allowed. What does this say? Any private use expenses are not allowed for private use. So private use expenses are also not allowed. So example, now let's take an example for the finance cost. That now you are an owner, you have 2 to 3 properties. If you have taken loan for all the properties, for 1 2 3 properties also, but the property number one you are using for your own self, so whatever your finance cost will be, then you can't reduce it, because this is your private use. The same rule also applies in the case of the expenditure. Whatever expenditure you are doing, but your property, the residential property you are using for your own self, the whole year you are using and you are living in that house and using as your main accommodation. For that you will not be able to deduct any expenses and you will not be getting any property income, so the rule does not apply here. Now example, if you are taking in property and for half year you are living and for half year you are letting it out, for half year you will be incurring the expenditure. For example, the water bill, electricity bill, all these will not be allowed. Only the 6 months which you are let out, for those 6 months expenses can only be allowed. Personal use expenses are not allowed under the property income head. There are special rules which applies to the capital expenditure incurred by an individual in an business. These all were the revenue expenditure, insurance, repairs, agent fee, as they are not increasing the income from your property. So these all will be allowed. But when it comes to the finance cost, we have some special rule. Special rule for non-residential property means it will be deducted. For residential property, we have a different way of getting the tax relief. Pre-trading means whatever we incurred before 7 years. This is before 7 years of letting your property, letting of your property. This will be covering in our chapter number 7, so you'll be knowing what does pre-trading means. Pre-trading means paying before starting your business. And expenses relating to private use are also not allowed. So now we will be dealing with some further expenses. So now we will be dealing with finance cost. Before that, as mentioned by me, revenue expenditure are allowed, capital expenditure are not allowed. Now when coming to the finance cost, as we know, for the finance cost we have two types: residential property non-residential property. In case of non-residential property, whatever is our finance cost, we will reduce from our property income. We will reduce from our property income. When coming to our residential property, we have special rules. As mentioned by me, how we will be claiming the tax relief. The tax relief will be claimed in the same way as we had claimed the tax relief for the person who is receiving the personal allowances under the marriage allowance rules. So we will be studying further in this slide. Now, the first point, owners of residential property who live in their own property, means the owner himself is using his own property, do not get the tax relief for their mortgage cost. What is the mortgage cost? Mortgage cost means finance cost. As in the previous slide I mentioned that I am owning 2 to 3 properties, and for all properties I have taken finance cost or the loan. So the finance cost which I am paying for my own personal use of my property is not allowed. When coming to the owners who buy and let out residential property, what is the rule? Tax relief is given on the residential property for the finance cost at a basic rate of 20% by reduction from the taxpayers, from which? From the taxpayers income tax liability. No part of loan finance cost is allowed as an expenses of the property business. No finance cost is an allowed expenses. How will get the tax relief? We will be getting the tax relief as at a basic rate, and the loan finance cost is allowed and as is not part, no part of the finance cost is an allowed expenses for the property business. Expense will not be, the finance cost will not be reduced from the property income, rather we will be getting a tax relief. At what rate? 20%. How you will take the 20%? This 20% will be reduced from the taxpayers final income tax liability. Clear with this? So these special rules apply to loan. These, what is the tax relief applies to the loan which we have taken. For what we have taken the loan? The loan is taken to improve, repair a residential led property, and also loan to acquire equipment or assets used for the residential letting businesses. Whatever is the loan amount you are taken for the repair, for the improvement, or for the acquisition of any assets which are used for the residential letting businesses. Clear with this? We get the tax relief at the rate of 20%, and when this relief is available to the owners who buy the property and let it out. But the owners who are buying the property and using for their own self, the relief is not available. The finance cost restricted includes interest payable as well as the incidental cost of obtaining the finance. So the finance cost, don't think that only the finance cost includes the interest amount. Now example, I have taken 10,000 pounds of loan to purchase an property and let it out. 10% is the interest rate. So I'll be paying 1,000 pounds. But to obtain the loan, I gave an agent fees or the broker fees of 100 pounds. So when you are providing the finance cost relief, that is the tax relief at 20%, this 20%, what is your amount that you will be getting the relief? The amount of relief you will be getting at the amount of 1,100 pounds. On this amount you will be getting the relief, that is into 20%. 220 pounds will be reduced from the individual's income final income tax liability. The finance cost does not only include the interest payment, it also includes the finance cost. It includes the incidental cost of obtaining the fees. So what the tax relief is provided on the interest payment plus obtaining fees for the loan. Clear with this? So now moving to our next topic, the next point. Note that these rules does not apply to companies or qualifying furnished holiday accommodation, and the interest related to a non-residential property such as leased office or warehouse is still fully deductible from the rental income as an expense of the letting businesses. So the finance cost, I told we have finance cost, we have two types of residential property and non-residential property. So non-residential property, the whole amount will be reduced, but for residential property only we have the special rule. When it comes to the companies, when companies are also letting out, the whole amount will be reduced from the whole amount will be reduced from the property income. When coming to qualifying furnished holiday letting, so we'll be further studying what are the criteria that needs to be satisfied in order to a property to become a qualified furnished holiday accommodation. So the finance cost special rule only applies to residential property and does not apply to companies, as property income will be for individuals. So for individuals this finance cost rule will apply. For companies it will not apply. When coming to furnished holiday lettings also it will not apply FHL, and for non-residential property. So clear with this. As when we come to our company income, company's profits, will be studying the property income there also. In that case the finance cost will be fully the finance cost will be fully allowed for companies, FHL and non-residential property. What does this mean? This means that the whatever is the finance cost and the obtaining cost of the whatever is the cost you have paid in order to obtain the loan will be reduced from the property income. So now further moving to the capital expenditure. What are the capital expenditure that will be reduced under the cash basis? As for accrual basis and cash basis, there are both different ways. What are the capital and what are the revenue that will be allowed? So revenue expenditure we discussed that wholly and exclusive for the purpose of property running business. Pre-trading expenditure will be reduced, and finance cost we have seen. Now coming to the capital expenditure. What are capital expenditure? The expenditure which are done in order to increase the earning capacity. As earlier mentioned by me, revenue expenditure will be reduced. Capital expenditure will not be reduced. So under the cash basis, there are generally no distinction between the capital and revenue expenditure in respect of plant and machinery and equipment for tax purposes. So what does this plant and machinery means? And the capital expenditure, now I'm constructing a further floor, so that will not be allowed. But the plant and machinery are small items. What are plant and machinery? Some small items and equipment for the tax purpose. So there is no much distinction under the capital and revenue expenditure. So expenditure on plant and machinery except car, because for car we have some different rules. Expenditure on plant and machinery used in property business, such as tools used for the maintenance of the property or office equipment used for running the business, is an allowed deduction from income when paid. So don't confuse that now I'm further taking in money and building my property, so that will be a capital, that will not be allowed. But to run the property, to run your property business, to run your property, you will be having a you will be needing some tools like hammer, nails, some office space, some small office you will be having. In that office you will be having chairs, you will be having some tables. So whatever these expenses are an allowed expenses. These are all of small amount. These all will be of small amount. So what are the capital expenditure that will be allowed? Capital expenditure for land and building, it is disallowed, as those are not plant and machinery. When it comes to the expenditure on plant and machinery, they are allowed. Plant and machinery does not cover cars we have some separate rules. So plant and machinery must specially be used for running the business, wholly and exclusively for the purpose of property business. So clear with this. So what are the capital expense that will be deducted? Capital expenditure on land and building will not be allowed. It will be disallowed. But when coming to the expenditure for the plant and machinery, such as small tools, some small machineries which are used for property or for running the property business, or you will be having a small office space where you will be dealing with your clients. So in that office you will be having some table, chairs, whatever you are purchasing it will be an allowed expenses. However, this general rule does not apply to car and assets provided for use in the residential property like furniture, TV. So for this, the replacement domestic item relief will be applying. So as here mentioned, the expenditure on plant and machinery does not cover the car, and it also does not cover the assets which are provided in the residential property. So for running the property business, you are purchasing some small tools or machinery, like you'll be purchasing the grass cutting machine, that will be allowed, because it is an tool which will you be using for running your property. But when coming to the cars, you have some separate rule we'll be covering further in this chapter. And when coming to the assets which are provided in the residential property like furniture, TV, dining tables, sofas, that will be having some special rules, that is replacement domestic relief will be further covering. In addition, capital expenditure on land and building is not an allowed deduction. As earlier mentioned, capital expenditure on land and building is not allowed. But when it comes to plant and machinery that are small tools, it is an allowed. Why these are small tools? Because they are used for our running the property. So it will be useful in running our property business. In addition, the capital expenditure on land and building is not an allowed deduction with the exception. What is the exception? Exception is that now capital expenditure on land and building is not allowed under the cash basis. We are still studying the cash basis. We are still studying the cash basis. Under the cash basis, it is not an allowed expenditure. But there are some exceptions. What are these exceptions? That whenever you are calculating your property income under the accrual basis, under which basis? Accrual basis. Under the accrual basis, capital allowances will be available. So what is capital allowances? We'll be studying further. So what are the exceptions of some non-residential property? Non-residential property like office, warehouse are different. In certain circumstances, non-residential buildings, not land, may be eligible for structure and building allowances. What allowance will be available? As we have seen, residential property and non-residential property. Non-residential property were warehouse, office. When coming to residential property, if we have done a capital expenditure on land and building, it is disallowed. When it comes to non-residential property, when it comes to non-residential property, non-residential property are the warehouse, offices which are used by whom? Which are used by trader. So this will be studying in our capital allowance chapter in the chapter number 8. So clear with this, capital expenditure are disallowed. Capital expenditure on land and building are disallowed. Capital expenditure on plant and machinery are allowed because they will be used for our property running businesses, small tools, etc. But capital expenditure is disallowed under the cash basis. Cash basis disallowed, but when you come under the accrual basis, you can claim capital allowances. So what does capital allowance means? Capital allowance means, in our accounting we have studied what is depreciation. Depreciation means you are using an asset and you are using the asset for 10 years, and each 10 years you will be expensing the usage of that asset. So that means depreciation. Depreciation means wear and tear of the asset. Now an asset you are using for 10 years, so 10,000 pound was the cost, divided by 10, so 1,000 pound each year will be the expense, because you are generating from that asset income. So income expenses will be reduced, in which they relate to income and expenses will be clubbed together, because this property, this depreciation, the depreciation is calculated because we are using this asset to generate income over 10 years. So to have an equal or fair accounting rules, we will be calculating. So the word capital allowance means this is a form of depreciation, is the accounting word. So the taxation word for depreciation is capital allowance. So depreciation and capital allowance are the same, but the rules for calculating the depreciation is different and the rules for capital allowance is very different. And each country will be having their different rules for the capital allowance. In UK we have different. We will be studying in a chapter number 8. So clear with this, the depreciation and the capital allowance. So capital expenditure on land and building is not allowed, but when it comes to non-residential property like warehouse and offices, you will be getting structure and building allowances, that is available in the chapter number 8. And property income we are doing under the head of individuals, but the structure and building allowance is available for trading purpose. You are doing some trading. But capital expenditure under the cash basis is not allowed, land and building. But when coming to when coming to accrual basis, you will be getting the capital allowances for the land and building. As capital expenditure on land and building is generally not allowable, but it is important to distinguish between improvements, that is capital expenditure, and repairs, that is revenue expenditure. Repairs expenditure is allowable, improvement expenditure is not allowed. So as I told you, revenue expenditure will be allowed, capital expenditure will be disallowed. What is capital expenditure? Which increases your earning capacity. Revenue expenditure does not increase your earning capacity. So now, before moving to further topics, we will be doing some questions so that you have a basic idea. So we will be starting with the question number 1. As we have seen, property income is calculated under the default basis of cash basis. Cash basis means cash received and cash paid. Then we see what are the expenses that will be allowed. What are the expenses that will be allowed? Revenue expenditure will be allowed, capital expenditure will not be allowed. But under the capital expenditure on the land and building will not be allowed. But capital expenditure for plant and machinery will be allowed, as this will be for small amount, and those assets will be used for running our property business. Then when coming to revenue expenditure will be allowed, but those all of the expenditure must be wholly and exclusively incurred for the purpose of wholly and exclusively for the purpose of business, wholly and exclusively for the purpose of business. Clear with this? Examples we have seen. Finance cost, we had different rules. Finance cost for non-residential property and residential property. Non-residential property, FHL and companies, it will be reduced from the property income. But coming to residential property, we will be getting a tax relief at 20%. Pre-trading expenditure will be deductible when we are calculating the first time the property income tax, whether it was incurred before letting it. And the finance cost, we have cleared it, we have seen it. Capital expenditure also, capital land and building is not allowed on the cash basis. Under accrual basis, you will be getting the capital allowances. For non-residential property, you will be getting the structure and building allowances. So now coming to the cars. Before starting our question, we'll be doing the basic concept for cars also, so that we can solve 2 to 3 questions of each topic or of all the topics. So now cars. What does the car means here is that now I am running my property. I am running my property business and I have a car. Why do I will be having a car? For example, now I have a customer. I am having a tenant who I am letting the property, and I will be providing him with a car. I will be providing him with a from airport. From airports I will be providing him airport services, or whether I will give the car to that person saying that you can use the car for the purpose. Now I am providing my tenant a house as well as I am providing a car. I'll say him, okay, this car is there, my driver is there, you can use this car also, because I'm using that car for my property business. Whether I use that car or whether my tenant use it, here this will be car will be in this situation, the car will be helpful. Car will be helpful in which cases? When I am using the car for my property business, I am showing the client the property. This is the house. So during the car is used for the traveling, so that expenses is also allowed. Or when I am providing the car to the tenant. Now example, an individual, I am an individual in India, I will be moving to UK. As for I'll be moving to UK. So there I need to stay in UK for 2 years for my employment purpose. But this house which you let out on your own, and this house which you let out was not provided by your employee. You have moved on your own and you have taken a house for your own. So whenever you are taking the home on your own and the car is provided by the owner to you, not by your employee. If your employer is providing to you, it will be covered under the employment income. So this employment income will never come into our picture. So this is cancelled. Now I am moving to UK and I am taking a house on rent, but my owner is also providing me car. I can use it whether I need to go back to the airport or whether I need to go somewhere else. I can use it. So how the expenses of that as a owner I can reduce it? Car which is wholly and exclusively used for the property running business, so I am providing to the to me, the owner is providing to me. So what will be, it is for property business purpose only. So we have some rules how the expenses will be allowed. The the car which is provided, no, the HMRC has provided us option number 1 and option number 2. Still we are studying under the cash basis only, so don't confuse with this. Under the cash basis, how the expenses for motor car or the cars will be allowed. So the option number 1 is capital allowances are available on the capital cost of the car. In this case, the actual motoring cost, petrol, insurance are also deductible. So what HMRC says that the car which you are purchasing for your property business, so you can avail the expenses can be allowed in two forms. Option number 1, option number 2. What does option number 1 says? That you can claim on this car capital allowance and whatever is the insurance or whatever is the petrol you are paying. So capital allowance I will be claiming on the cost of the car, and now further I am filling petrol, I am paying the insurance. That total amount you can deduct it. That total amount you can deduct it from your property income. But the second alternative that is provided by HMRC is approved mileage allowances. These approved mileage allowances will be provided in the tax rate sheet. So what does this rate says? What this approved mileage allowance says, which is provided by HMRC, is that instead of claiming the capital allowance and actual motoring cost, what was the first option? You can claim capital allowances plus actual motoring cost, your actual motoring cost, that is petrol, insurance, etc. The second option is approved mileage allowance. What does this approved mileage allowance says is that if you travel your first 100 your 10,000 miles, it is at 45 pence. Over 10,000 miles, it is at 25 pence. What does this means is that now I am owning a car, I am using for my business purpose, property business. The car I was purchased and the car I purchased and I'm incurring petrol, insurance cost. Whether you can calculate the capital allowance and the actual motoring cost as your expense, or the car, for how much mileage the car was used, how much or how many miles the car traveled. If the car was traveled for first 10,000 miles, means 45 pence. Pounds means, see, take example, 1 pound is equal to 100 pence. 1 pound is equal to 100 pence. Keep this in mind. And this p is not pound, the p is your pence. The p is your pence. So now example, my car has traveled for the whole tax year for 5,000 miles, for whole property, for the tenant also, for me also. So into 0.45, so you will be getting in pounds. Your answer will be pounds. So if you do this, you will be getting 5,000 into 0.45, 2,250 will be your expense. This you can reduce from your property income. Clear with this? If my car has the car was drawn, or the car was used and car has traveled 11,000 miles, so for the first 10,000 miles you will be charging at 0.45. For the rest 1000 you will be applying at first 10,000 0.45 pence, 0.5 pounds, and for the next 1000 you will be taxing at the allowance you can claim is at 0.25. So this will be 4,500 and this will be 250. So the total how much you can claim? 4,750. This you can claim under the property income. You can reduce it, the car which you have used. So there are two options, students. What is the option number one? Option number one is capital allowance plus actual motoring cost, whatever is your actual motoring cost, petrol, insurance, etc. Or you can use the HMRC approved mileage allowances. How the approved mileage allowance can be used? By seeing how many miles your car has been drawn or car has been used. So for first 10,000 miles it is 45 pence, and for over 10,000 miles it is 25 pence. So if you use the mileage allowance, you can't use the capital allowance and actual motoring cost. When a person decides to use the capital allowance or alternative, which one an individual select? If I am an individual UK and I am doing the property business, I have the both options to select. Which I will select as an individual? I will select the option which has more expense, which gives me more expense, because the expense I will be reducing my from my property income. If I reduce from my property income, I will be getting my net income. That net income will be taxable. If my expense, the expense I will be reducing less, means more income. More expenses means less income. So as mentioned here, from both the option, the taxpayer will select the option which benefits to him, that is, which gives a higher expenses. If take an example, your capital allowance, you are calculating the capital allowance and your actual motoring cost gives rise to 20,000 pounds, and the mileage allowance will give you 30,000. So which one you will select? You will select this option, because this option will reduce your property income and you will be having a lower tax. This an individual can choose, as the HMRC has provided two options for them. So I think we will be clear with this also. Car concept. What is car? The car has been purchased for property letting business. So we have two options how we can reduce the expenses. Option number one, calculate the capital allowance on the car, or capital allowance plus actual motoring expense, or option number two is HMRC approved mileage allowances. So HMRC approved mileage allowance, this will be provided in the tax rate sheet. So now students, do not confuse what I told. The capital expenditure will not be allowed, and capital allowance will be only available under the capital allowances. So what is the capital allowance? The capital allowance will only be, the capital allowances will only be available under the accrual basis. That is for capital expenditure for land and building. But HMRC says that when it comes to car, you can claim the capital allowance under the cash basis also. But in the previous slide we studied, do not confuse the students. Capital allowance is a form of depreciation. This is an replicate of taxation depreciation, because HMRC, because the taxation rules does not apply the accounting depreciation. So we'll be calculating the capital allowance. Capital allowance under the capital expenditure for land and building is only allowed under the accrual basis. But when coming to the cash basis, it will not be allowed. But when coming to the cars, you need to calculate the capital allowance plus actual motoring car. Capital allowance plus actual motoring car, or the approved mileage allowance, whichever will provide you a higher expense that you will be reducing, so that an individual gets lower property income, so low tax. So now we will be doing some 2 to 3 questions. So these all, whatever topics we have covered in the 2 to 4 to 5 slides will be covered. The car, the capital expenditure, the finance cost, and the cash allowable deductions for the property income, and the cash basis. So starting with the question number 1. So X is an individual owns a property that was let for the first time on 1st July 2023. It was first let on 1st July 23. The rent of £5,000 is paid quarterly in advance. Every quarter he is paying the rent in advance. It is yearly. On the first of the month, X paid allowable expenses of 200 in December 2023 related to redecoration following a burst pipe, and 400 pounds in May 2024. This 200 was for the burst pipe, and 400 in May relates to repair work which was completed in March 2024. Calculate the X property income. So X is an individual, he is having a property income which he is paying in advance each quarter. So what are the quarters? From July to September, October to December, January to March, April to June. But what is our tax year? Our tax year end till year only. This will be included in our tax year till 6th April 23, 5th April 24. But here the catch is what? Here the catch will be that he is paying on the 1st. So on July 1st he will be paying, October 1st he will be paying, October 1st, 1st July and 1st April. So my property income will be, the X property income will be property income, rent received. What will be my rent received? Rent received will be the whole 5,000, because what is the basic rule? The basic rule for property income is will be taxed under the cash basis, students, because nothing is mentioned here. If it was mentioned accrual basis, then we need to calculate on the accrual basis. Here already they have mentioned that it is cash basis. What does cash basis means? Cash received less cash paid. Now cash is paid, received on 1st of each quarter from 1st July. 1st July we are receiving it. 1st July fall under the tax year of 6th April. 1st July 23. 1st October falls in the same tax year. 1st July, 1st January also same tax. 1st April, our year end is 5th April. So 1st April also fall in this tax year. But the income is for the next year. This income relates to next year, but we are following the cash basis. Keep in mind, we are following the cash basis. Cash basis means cash received less cash paid. Whether it relates to any period, you will not see the income or expense which relates to whether they relates to the current year or future year. No, whether it relates to future or previous, you need to consider when it was received and when it was paid. So now coming to the expenses. The expenses paid, when was the expense paid? In December. So December 2023 is this tax year. So this is an allowable expenses. As I told, what are the expenses that will be deducted? Only allowable expenses which are for the purpose of the business. So allowable expenses will be deducted. So in case of burst pipe, so burst pipe, what it was? 200. So that also, see, the pipe was burst. Now if you replace the pipe, it will not be a capital expenditure, because it will not increase your revenue. It will not increase your revenue. It will not increase your revenue. So it is what type of this, students? It is a revenue basis, so it will be allowed. It is not a capital basis, because it is not increasing your earning capacity, so it is an allowed. And second, 400 pounds paid on a repair work, so which was completed to 2024. So this was related to March only, but when it was paid, we need to see the payment date. It was paid in May. The repair work will be allowed or not allowed? This will not be allowed. Why? Because it was paid in May, students, May 2024. This follows in the next tax year, that is 24-25. So our property income under the cash basis will be, what will be? 4,800. So students, one basic point I'll be saying that in the taxation, in your section C, as you need to draft your answer. So if you did not mention this point also, you would be getting your answer as 4,800. But the key is that whenever in the taxation, now this repair is disallowed. So you need to mention a note, or you need to mention that note number 1, that the repair work of 400 is not allowed because it was paid on May 2024, which does not pertain to this time, but the amount is related to this year. Clear with this? Keep in mind, in the taxation paper, in the section C, you need to give the note. Now you are, if you do not reduce also, no, you will be getting the answer same only, but the examiner will be thinking that the student don't know this topic. You will be knowing, you have done your answer right also, but you will not be getting marks. So you need to say why you have not deducted it. Each and every point you must explain to the examiner. Note means repair work is not allowed because property income is under the cash basis, and the cash amount is paid on May, but the work was completed in the current year only. Clear with this? Now if I take the same question, if I take the same example, now if I take the same example for accrual basis, what would be my answer? Accrual basis, what is my property income? We will be calculating it. Rental amount, rental amount. Under the accrual basis, you need to keep in mind that the income which relates to that period only will be taxed. So when we let out our property, we let out our property on 1st January, 1st July, sorry, 1st July. So 1st July till March, what is your 6th April? July, August, September, October, November, December, January, February, March. Only 9 months you will be taking. Only 9 months you will be taking your income, because this is accrual basis, student. Excuse me. So your income will be 3,750 pounds. Less expenses. Allow expenses means, first one second, redecoration will be allowed as it is already paid and related to this year. So what was it? 200. And when coming to the repair expenditure, this will be allowed under the accrual basis. Why? Please see, student, here. Why means the work was completed in March 2024. So it relates to which year? 23-24, no? So it will be reduced under the accrual basis. What was the amount? 400. So your property income under the accrual basis will be 3,150. Clear with this, students? 3,150. So what is the basic rule for property income? Property income basic rule is on cash basis. Cash basis means cash received less cash paid, which relates to any period, no issues. Whether it relates to current period or future period, no issues in that. When coming to accrual basis, the cash received and the rental income we receive and the expenses which we pay must relate to that period. In this example, the rent which we receive. See here, students, the rent which we receive, no, here only for this period, for the tax year of 23-24, 1st July till 5th April. So we'll be calculating on a monthly basis, not on a day-to-day basis. So we'll consider till 30th March only. So for this period only the 9 months relates, the property income only relates, this 3,000 relates to 9 months, and under accrual basis we will be calculating on the cash received or cash paid, but we have already received it, but the 5th April also, but on 1st April we'll be receiving, it will be a liability to us. We will not be considering this, because what does accrual basis say? Whatever income relates to that year only you will be considering. What is the income that relates to that year? That is only 9 months. So that, and redecoration also was related to that period, and repair also was related to that period, but it was paid in next year, paid May 24, but we are considering in this year only. Why? Because it is accrual basis, and cash basis will not be considering because we are paying next year. So clear with this? By solving this question, your cash basis and accrual basis must be clear. So moving further to our second question, which relates to the finance cost. In this question, we will be seeing how you will be dealing with the finance cost element. So question, X owns a residential property. Okay, it is a residential property. Tax relief will be available. Residential property, tax relief. Finance cost, tax relief only available for residential. When come to companies, FHL and non-residential property, it will be deducted directly from the property income. X owns a residential property that he lets out during the tax year 23-24. He received a rent of £15,000 and paid the following expenses: agent fee 1000, insurance 1500, gardener's cost 1300, indirect cost, interest cost on the loan to acquire properties 7500. During the tax year 23-24, Adam means X year also has a trading income of 42,000 pounds and bank interest of 8,000. Calculate X income tax liability after relief from the tax year 23-24. So here we need to do everything. Chapter 1 is also linked here. Chapter 1, chapter 2, everything. Chapter 2 and chapter 3 are linked now. So now we will be doing with a further question. Now solving this, we need to calculate the income tax liability. So how will we calculate income tax liability? Non-saving income, saving income and dividend income. So under the headers non-saving income, what will be coming? Trading income. Trading income. What is the trading income? 42,000 pounds. And he has a property income also. So property income will be coming under the head of non-saving. And now we need to calculate the property income. So here we will be calculating what is the property income for Adam or X. Adam is here X. So Adam. Property income. So refer note number 1. Note number 1. Property income. Now what we need to follow? Cash basis or accrual basis? Anything is mentioned? Nothing is mentioned in the question. So we'll be calculating under cash basis. That is rent received. What is the rent the individual is receiving here? What is the rent the Adam is receiving? 15,000 pounds. Less expenses. What are the expenses that will be reduced? Sorry students, 1 minute. Here we'll be having our total column. I forgot. So now note number 1. Note number 1. What does the note number 1 says? Note number 1 says we will be calculating the note number 1. We will be calculating the property income for Adam. Property income. Property income. So property income means rent received. What is the rent he is receiving? 15,000 pounds. Because property income is calculated on the cash basis. Clear with that topic? Cash basis. Nothing is mentioned here. So we'll be following the cash basis. Less expenses. So what are the expenses? Agent fees will be reduced. Yes, because it is wholly and exclusively for the purpose of property running business. 1,000 reduce it. Allowed expenses. Insurance will be reduced. Yes, wholly and exclusively for the purpose of property business. Gardener cost, wholly and exclusively for the purpose of business, for the property business, that is 1,300. Finance cost will reduce here. No, it is a residential property. See here, it is a residential property. For residential property, we will be getting a tax relief. So what will be our property income? Total property income. Our total property income will be 11,200. Our total property income will be 11,200. 11,200. Then we have further, Adam has a further bank interest of 800. So total will be 42,000 pounds, 11,200 pounds, 800 pounds bank interest. So no dividend. So this will give rise to total income. So saving, non-saving and dividend income. So what will be a non-saving total income? It will be 53,200. For saving it will be 800 pounds. For dividend it will be 0. And our total income will be 54,000. So reduce any relief, whether we have any relief, no. So this will give rise to our net income. Our net income will be same as our total income, because we do not have any, we do not have any relief. So less PA. For PA we need to see whether our income is more than 100,000 pound to see whether our PA is getting tapered. Our income is not more than 100,000 pounds, so PA will be available of full 12,570. So you will be getting, after reducing our PA, will be getting our taxable income. And the order for setting of the PA is non-saving, saving and dividend income. 12,570. So our taxable income, non-saving income will be 40,630, 800 for saving, dividend 0. So our total taxable income will be 41,430. So now we need to calculate the income tax liability. Income tax liability. Income tax liability is calculated on taxable income. So our taxable income is 41,430. Now for non-saving is 40,630. Of this, non-saving is this much, saving is 800, dividend is 0. So income tax liability will be first 37,700, because the non-saving income is covering the basic rate limit at 20%, so will give rise to 7,450 pounds, and the excess will be 40,630 minus 37,700. This will be excess will be 2930 into 20% into 40%, as it is in the higher rate limit, so it will be 1172. Now coming to the saving income. For saving income, first we must see the first 5,000, whether the saving income falls within the first 5,000 of the taxable income. As our taxable non-saving income is more than non-saving 5,000, as our taxable non-saving income is more than 5,000 pounds, so the first 5,000 pound rule will not be available for the saving income. The second, we need to see the saving income nil rate band. If he is a basic rate taxpayer, he'll be getting a 1,000 pound saving nil rate band. If he is a higher rate, he'll be getting 500 pounds. If additional rate, nil. So to determine whether he is what type of taxpayer, we need to see whether his total taxable income fall under which band, whether basic rate, higher rate or additional rate. As this falls under the higher rate band, so as this falls under the higher rate band, the saving income nil rate band will be 500 pounds. So saving income 500 at 0, and the rest 300 will be at 40, because the first limit has been used by the non-saving income. So this will give rise to 1,200, or 300 means 120, sorry. So our total income tax liability will be total income tax, so our total income tax liability will be, students, 7540 plus 1172 plus 120. This will give rise to 8,832. Now this will be a total income tax liability less tax relief. What is the tax relief? The tax relief is on the interest amount. What is the interest amount? The finance cost is 7,500. As it is a residential property, how the finance cost will be reduced? The finance cost will not be reduced from here, will not be reduced from the total income. Only it will be reduced from the property income. When? Not total income. Property income when it comes to non-residential companies and FHL. So tax relief is 7,500 into 20%. So this will give rise to 1,500 pounds. So our total income tax liability will be 7,332. So clear with the finance cost. How the finance cost will be dealt? The finance cost will be reduced from The finance cost will be reduced as a tax relief, will be done as a tax relief. So now we have covered these areas, the finance cost, the property income, the cash. We have done under the cash basis also and under the accrual basis also, both we have solved. So with this you will be having a good idea. We have further question of accrual basis, so we'll be solving that now. We'll be seeing some further rules, then we'll be moving to the this topic. Now coming cars, we have seen we have two options. An individual has two options whether to claim capital allowance plus actual motoring cost or HMRC approved mileage allowance. This will be provided in the exam. That is, if the car is drawn for first 10,000 miles, it is at 0.5 pounds, and above 10,000 will be at 0.25 pounds. First 10,000 at above 10,000, don't consider this as that I am drawn 11,000, so directly on 11,000 it will be no. First 0 to 10,000, this 10,001, above that it will be at this amount. In these two options, which one the taxpayer will be selecting? Which one will give the higher expenses? Because this will reduce the property income and low income tax will be paid. So now further moving to the replacement domestic relief. So as we have seen in the capital expenditure, that capital expenditure for land and building not allowed, plant and machinery will be allowed, but when coming to cars we have special rule, we have already learned. But when coming to the assets provided for residential property like furniture, TV, replacement domestic relief will be available. What is that? We will now be covering that. Replacement domestic relief. As the word replacement domestic relief, from the word only you can say what is the relief. If you are replacing any asset, you will be getting the relief. Replacing your domestic item, you will be getting a relief. So now we will be studying how we will be getting this relief. So example, now this relief applies to assets which are provided along with the residential property. Example, furniture, TV, etc. So this will be provided to furniture, etc. Now coming to this relief now, example, you are providing some property or something for letting out, and if you are providing the furniture, TV for the first time, you can't claim the capital expenditure because that are not allowed, as they are not, it is not allowed. When you are replacing it, you will be getting this relief. Now we will be covering this. As stated, expenditure on assets provided for use in the residential property like furniture, TV is not allowable, because the expenditure which you incurred on TV expenditure is not allowed. In addition, capital allowances are also not available. However, for furnished residential letting, a special relief, replacement domestic relief, is also referred as replacement furnished relief, is available. So this relief, what does it say? Is that the assets which you are providing in the residential property, that is furniture and TV are the assets. So these are not allowed. You can't allow those. You can't reduce it. You can't, are not allowable expenditure. Are not allowable expenditure. So for this case, you have a different relief, that is domestic replacement domestic relief. So what does this relief says is, the relief allows a deduction for the replacement, not the original acquisition. What is it saying? Not the original. The relief allows deduction for replacement, not original. Now when you are letting the property for the first time and you are incurring the expenditure for the furniture, TV, it is not allowed. This is your original acquisition. But this relief only applies to replacement of those items, replacement of those domestic items. So this relief allows a deduction for replacement, but not the original acquisition of the domestic items provided by the landlord. So what is this relief? What does this relief says? How this relief is available? The allowable deduction, what is the amount that you can reduce from your property income? Replacement cost less any proceeds from the disposal of the original item. You are now, example, you are having a TV, you are provided to the tenant, you first installed it. At the first installation, this expenses cannot be allowed, it will not be allowed. But now this property has damaged and you need to replace it, so you are replacing it, so the replacement relief will apply because it is now replacing it. So what amount you are allowed to what amount you are allowed to reduce it? Now example, you are purchasing 10,000 TV and this old TV you are selling at a scrap of 2,000 pounds, so the 8,000 net amount will be allowable deduction. Clear with this, students? Allowable deduction. What is the net amount? Net amount, that is inflow minus outflow minus inflow. What is the net amount which is going out of your pocket? Out of your pocket, which is, what is the net amount that is going from, that is net going out of your pocket, net amount? You are purchasing TV, new TV, and again you are getting the scrap from the old TV, so that is the net amount, that will be an allowable deduction. But here you have one condition. What is the condition? The HMRC says that the condition is that the replacement cost is allowed, is limited to the cost of similar items, that is like to like items, only like to like items can be purchased. The replacement cost, whatever the cost you are replacing it, is limited to the cost of similar items, excluding any improvement but allowing for a modern equipment. So what the HMRC is saying, the rule is saying that now you are replacing the TV, you are replacing the TV. With TV you can't get PS5. Now you are replacing it, you are, see, you are replacing the TV also and you are getting the PS5 also, you are getting it. But the replacement relief is only available for the TV, is not available for the PS5, because PS5 is doing some improvement in it, and it is an addition thing. So what the relief says, that the replacement cost is allowed and is limited to the cost of similar item. Only similar item you can purchase. TV to a TV, not, you can't replace TV plus, PS5, but you can, but allowing for modern equivalent. Now the TV which you purchased first was not a Wi-Fi TV. First you purchase a TV which did not have Wi-Fi connection, but now you are purchasing another TV, the old TV you are replacing it, and you are purchasing a TV with Wi-Fi, because there is modern equivalent to that. And now all the TVs are coming with, now wherever you go and wherever TV you purchase, whatever television you purchase, will be with the modern equivalent, will be with the Wi-Fi option, that you can't remove from it. So what does this relief says is that you are selling some asset, you are replacing some asset and purchasing a new asset. At the starting of the providing the asset, you will not be allowed an expenditure, but when you are replacing it, you will be provided deduction. What is the deduction? Whatever is the amount you are paying for the new asset less the scrap value. But when you are purchasing the new asset, the condition is what? The asset must be of the same, must be of similar item, and there should not be any improvement or any extra thing, but and modern equivalent can be purchased. Modern equivalent means, nowadays many TVs are coming with Wi-Fi, or many washing machines are coming automatic. First you used to get washing machine manual, now automatic washing machines are coming. But you can't replace a washing machine with a washing machine plus dryer. You can replace the washing machine with washing machine which is new and automatic, because in this era, in this generation, the all the washing machines are coming at a automatic stage only. All the washing machines are automatic. So keep in mind, replacement domestic relief says that the allowable deduction amount is replacement cost less any proceeds from the disposal of the original item, because during the original acquisition you are not allowed it, but you have a restriction. What is the limit? The replacement cost is allowed to limit is to the similar items. So as I've given the example of washer plus dryer, only the cost of replacement washing machine could qualify. For example, if washing machine is replaced with a washer plus dryer, only the cost of replacement washing machine is qualifying for this relief. Example, washing machine plus dryer I purchased for 10,000. The dryer cost is 2,000. What is the amount that is available for replacement relief? Only 8,000 will be available. And the previous machine I sold for 1,000 pounds. So my the allowable deduction will be 800 pounds minus 1,000. So 7,000 is the amount that can be deducted. This replacement relief says that the whatever asset you are selling, the asset must be similar. It should not be with some other improvement, but it can be modern equivalent. As the generation is changing, some other updates are that you can take that, but you can't take any improvements in that. As an example, for washer it will be dryer, and when compared to TV, you can't get a PS5 station. With TV you can get the Wi-Fi TV. Now all the TVs are coming with Wi-Fi, so you can purchase those. Domestic items are those acquired for domestic use, for example, furniture, furnishing, household appliances, including white goods, carpets, curtains, and kitchenware. Here, carpets and curtains are also included. Don't confuse that curtains and carpets are not included. Carpets and kitchens are also included. However, fixtures, that is any plant and machinery that is fixed to the dwelling, including boiler and radiator, are especially excluded. What is the difference between the fixtures and these, students? The difference is that fixtures are not allowed. Fixtures are not allowed. Fixtures are not allowed. What are fixtures? Fixtures are means like switches, switchboard, which are fixed, which are already fixed. These are not allowed. Or radiators or hot boilers, water boilers are also not allowed. This replacement domestic relief is only available for furnishing, furnitures, household. Only to those it is available. Clear with this? But it is not available for fixtures now. It is not available for fixtures. What are fixtures? Fixtures are those things which are already fixed in that house, like switchboards, your boiler, your heaters, your radiators. These are all. On these items you will not be getting your replacement domestic relief. Clear with this, students? I hope this replacement is clear to you all. Replacement of domestic relief is clear. Clear with this? So let's take this relief is not available for furnished holiday lettings and accommodation, or for which rent a room relief has been claimed. So now we will take a brief short summary and we'll do a question on this. So replacement domestic relief says means whenever you provide small assets or some small assets like furniture, TV in your residential property, when you originally provided during your first time, that amount you will not be allowed to deduct it. But when you are replacing those assets, whenever you are replacing those assets, you will be getting a replacement domestic relief. What does the replacement domestic says? Replacement domestic relief says what is the amount that you can reduce, that can you reduce from your property income. What is the amount, students? The amount is replacement cost less any proceeds from the disposal of the original item. Whatever is the cost you are paying to acquire the new asset, less what is the cost, what is the proceed you are getting from selling the old asset, Clear with it? But we have a restriction. What is the restriction? The replacement cost is limited to an amount. What is the amount that is limited? Only similar items can be purchased, excluding any improvement. You can't purchase an item which is having some improvement, but you can purchase an item with a model and equivalent. For this example, we have seen the example of a TV, and we have seen an example for washing machine. So washing machine plus dryer, if you only had at the original, you only had given the washing machine, you can only replace it with washing machine, not washing machine plus dryer. So only the cost of replacement washing machine would qualify for this relief. Only what is the amount of washing machine will qualify for this relief. How you will calculate this relief? Whatever is the washing machine amount less the amount which you got by selling your old washing machine, that amount you can reduce from your property income. Clear with this, students? Domestic items are those acquired for domestic use: furniture, furnished or household appliances including white goods. White goods means refrigerators, washing machines, those are white goods. Carpets, curtains and kitchenware. However, fixtures are not included. Fixtures are not included under the, do not confuse, these fixtures are not, will not have the domestic relief. Any plant and machinery that is fixed to dwelling including boilers and radiators are specially excluded. This replacement domestic relief is not available to FHL business, furnished holiday business, furnished holiday letting. We will be covering what are the conditions such that a property will turn into a FHL letting. So on that, these replacement domestic will not be available, relief will not be available on this. And rent a room relief. Rent a room relief means, now I am having my home, I am having a 10 rooms in my home and I am letting out 2 of my rooms. In that case, this domestic item, replacement domestic relief will not be available. Clear with this? In this case, the rent or room relief, I am only providing 2 of my rooms and the rest I am using for my personal use. For personal use, we can't reduce any capital expenditure, so no issues in that. So the replacement relief will not be available for the FHL business and rent a room relief. Keeping this in mind, because the FHL business has other rules and the rent a room relief has other rules. We will be studying further. But this replacement domestic relief will be available only for a maximum limit amount, that is similar items, not improving that asset, but modern equipment can be purchased. So now we will be solving a question so that you will be having a clear picture on this topic, replacement domestic relief. So this question is a big one. First we'll discuss the whole question, then we'll be solving the answer. This will be covering each and every topic, students. So let's maximize the view so that we can read the question properly. Question for replacement domestic relief. X is a person who owns a cottage that she lets out furnished at an annual rent of 3,600 payable monthly in advance. Okay, X is a person who has a furnished home and she is letting annual rent is 3,600 pounds payable monthly in advance. So the amount is paid monthly. She incurred the following expenditure. What is the expenditure? May 2023. Replacement of bedroom curtains. She have replaced it. So replacement means replacement relief will available. On May 2023, replacement of one broken kitchen unit in a fitted kitchen with a unit of similar standard. Okay, it is similar, it will be allowed. June 2023, insurance for the year from 5th July to 2000, from 5th July. Previous year was 420 and this year it is 480. November 2023, dishwasher, she 380. She incurred these are all the expenditures. May 2024, redecoration, work completed in March 2024 of 750. The tenant had vacated the property during June 2023 without having paid the rent due for June X. For June X, that is the person who is the owner. X was unable to trace the defaulting tenant but managed to let out the property to new tenant from 1st July 2023. The new tenant paid a security deposit of 800 pounds to Amal on 1st July 2003. X is Amal here. The old curtains had no disposable value. The dishwasher had not previously been provided in the property. X drove a 120 miles in her car in relation to the property business during the tax year 23-24. X claims HMRC approved mileage allowances. Now see, we have all the topics here, leaving the finance cost. Now calculate the property income for the tax year 23-24. Now we need to calculate the property income. So how we will be calculating a property income, students? Property income. How we will be calculating a property income? property income. First step is to see whether the examiner has mentioned whether we need to calculate on accrual basis or not. Here nothing is mentioned, so we will be calculating on cash basis. Cash basis means cash received and cash paid. This will give rise to our assessable income. This will give rise to our assessable income. So now, what is the rent? Rent received. What they are saying, the rent received is X receives an annual rent of 3,600. So 3,600 divided by 12. So per month they are paying us, see students, 3,600 is annual amount divided by 12. So per month rent is 300. Clear? And is paid in advance. But what is this? They have told here the tenant had vacated the property during June 2023 without paid the rent due for June. So June rent he did not pay only for us. So we did not receive it. Cash basis means whatever amount you receive. So June amount we did not receive it, and only we need to calculate for 11 months. 11 months amount we will be receiving it. So this, after that Amal was able to give the property to new tenant from 1st January only, and if on 1st January, then they will receive the rent of 3,000 will receive on 1st July. So our rent receive will be 300 into 11 months, that is 3,300. And students, don't confuse that they are paying in annually. Now take 1st April, they are paying on 1st April, 1st May, June, July, August, September, October, November, December, January, February, March, April. This they paid us 300. But this will be covered in the previous tax year. Our tax year will be previous year. Our tax year is 23-24. 23-24 means 6th April 23, 5th April 24. And this was paid on 1st April. So 1st April means previous year. So we'll not take this into consideration. Clear with this? We'll not take this into consideration. Am I right? So May, okay, 300 will receive it. June, we can't receive it because he did not pay only. It is not accrual basis, student. Here it is cash basis. Whatever we receive. July we have received 300. From here we have given to the new tenant. For all these months he had paid us. And till April, next April also he paid. April 24. But it is 1st April. So 1st April lies within this tax year. Which tax year? This tax year. So this 300 will also be included. So what are the number of months? This will be excluded. 1, 2. This, no. What are the months? May, June, no, because we did not receive it. July, 2, 3, 4, 5, 6, 7, 8, 9, 10 and 11. So 11 months we need to calculate our property income, that is 3,300. Clear with this? Do not confuse with the accrual and cash basis. First you need whether you need to calculate under the cash basis or the accrual basis. So this is this. Now less expenses. Less the expenses. What are the expenses now? We'll be studying with further each one by one. First expenditure she incurred is May 2023, replacement bedroom curtain. Okay, they are replacing it. So residential property, it is not an FHL and it is not a rent a room relief. So replacement relief will be available and they are replacing it and replacing it with same. So less expenditure for replacement curtains. Curtains we can reduce it because relief is available. Replacement relief means what is the amount that is allowable deduction. Cost of the replacement less any scrap value you received. What they have given here, the old bedroom curtains had no disposal value. So disposal value will be 0. So total amount 150 will be deductible. Clear with this? Now the next is replacement of one broken kitchen unit into a fixed kitchen unit of similar standard. So kitchen unit, what is the replacement cost? 275. And what they have given that it was of similar standard. So no need of any issues because it was of similar standard. What does replacement domestic relief says? Replacement domestic relief says that the item which you are purchasing new must be of similar standard. Similar standard means Similar standard means no improvement, but modern equivalent can be there. So 275 can will be also allowed. Now November 2000 June insurance of year from 5th Jan, this insurance will be, as it is paid on 5th July, it is paid under the cash basis, it is paid means it will be reduced. Insurance of 750 will be reduced. So insurance, as it is cash basis and it is paid, students, it will be reduced. Now dishwasher. Now coming to the head of dishwasher. What is dishwasher? Read the line. The dishwasher had not previously been provided. So it was not previously provided and it is an asset. So it will not be allowed. Replacement relief will not be allowed. So 0. I told you in section C you need to mention why you are taking 0. The examiner needs to know that you know the concept or not. So note number 1. What is the note number 1? Dishwasher is disallowed as replacement domestic relief does not apply. Relief does not apply. Why? Because it was not originally not provided. Clear with this, students? Then coming to the redecoration expenses. Work completed in March 2024. But when was the payment made, students? The payment may include this year. June also include. November also. May. It was paid in May 2024. This relates to next year, 24-25 tax year. So this redecoration expenses can't be allowed because it is relating to, it is paid in the next year under the cash basis. What does cash basis say? Whatever we are paying and receiving in that tax year will be calculating it. So redecoration is 0. Note number 2. For this also you need to mention a note number 2. So note number 2 means redecoration expenses not allowed because paid next year, as it is, as property income is calculated under cash basis. So this will give rise to our, and then further what other we have? We have car also. So the car was drawn for car expenses 120 miles and they are following the approved mileage allowance into 0.45. This will give rise to 54. So your property income will be, your property income for the tax year 23-24 will be 2341. This question is very important, students. You need to do this. Is question comprises of all the areas: the car mileage allowances, the replacement relief, and replacement means the asset must have originally been given. If it is originally been given and we are replacing it, replacement domestic relief will be available. Maximum, the cost, the maximum limit is the, that is similar standard goods of item must be provided. Whether similar item must be provided, no improvement must be there, but modern equivalent can be there. So by this question we have completed the question number 3 also, that is replacement domestic item. By doing this question you would have a clear picture of the replacement domestic relief. So in redecoration also you need to see whether it is revenue or accrual, revenue or capital expenditure. Now coming to the accrual basis. Now till now we were done with the cash basis. Now coming under the accrual basis. Accrual basis. What does accrual basis means? Accrual basis means cash receivable and cash payable. Then period, that is which period of income and expenses are relevant. As in our first slide we had discussed it. Period of income and expenses is relevant. Keep this in mind, students. Property income accrual basis. An individual or a partnership may opt to use the accrual basis, and it may be used if property income receipts exceeds 1 150,000 pounds. What does this say? I mentioned you that when we will be using the accrual basis will be used if the examining question, if the examiner specifies that you need to calculate on the accrual basis, or individual or the partnership income from the property is exceeding 150,000 pounds. However, in the examination, it should only be used if the question specifies to use. So, the property income will be calculated on the accrual basis when an individual's property income receipts will exceed 150,000 pounds. If receipts, I am receiving it and my income is more than 150,000 pounds, then I need to move to accrual basis in practical world. But when coming to our exam, how we will get to know? When coming to our examining, the examining question will specify that you need to do in accrual basis. If does not specify, simply follow the cash basis. If they specify, simply follow the accrual basis. When it is will follow in the practical world, when the income of an individual from the property exceeds 150,000 pounds, 150,000 pounds. So, under the accrual basis, the main difference is that the rental income and the related expenses are assessable and deductible on an accrual basis. What is accrual basis? Rent receivable and cash expenses payable. Rent receivable and expense payable in the respect tax year. If a tenant leaves without paying outstanding rent under the cash basis, the outstanding amount is never taxed. As in a previous example, here we took, no students, here we took that here we are calculating under the cash basis and 1 month he did not pay it, so it is an loss for us. But under the cash basis, the automatically will be calculating at 3,300 only tax. But coming under to the accrual basis, if the tenant leaves without paying outstanding rent under the cash basis, the outstanding amount is never taxed. Yes, both accrual basis also cash basis, the outstanding amount will not be taxed because we did not receive that income. Without receiving that income, how we will pay the tax? But the difference is cash basis and accrual basis. Cash basis, no adjustment is needed because whatever amount you receive, you will pay tax. You did not receive, you will not consider it. Accrual basis means you will consider the whole year income, 12 months income you will consider it. But 1 month you will not receive means you will be paying the tax on the whole amount. So this 1 month you need to reduce it from the income. So the amount will be, the tax amount will be calculated on the same amount, whether it is cash basis or accrual. When coming to the receipts, the income you are receiving it, but the difference is of the presentation. Here no need of adjustment, here adjustment is needed. Here in cash basis, why no adjustment is needed? Because already you will be considering 11 months amount only, the amount which you receive. But accrual basis you will not consider it, you will consider 12 months income. Then below that you must show less impairment loss. This is a loss for you. So under the accrual basis, the amount receivable is taxed, but the outstanding amount owed can be deducted as an expense. This irrecoverable debt is referred to as impairment loss in your examination. In your examination question, they'll mention you, okay, you have an impairment loss. Impairment loss means you need to reduce from the amount, outstanding amount that is going to be taxed. So clear with this point? This point is very important, as we in our previous question we have done this. Cash basis means what is the cash you are receiving it. Accrual basis means you need to, whatever amount is pending from your tenant, you need to reduce it from your, you must reduce as an expense because you will not be receiving it. Clear with this? Only the presentation way is different, but the calculation is same. Cash basis and accrual basis. The other main difference is that the expenditure on plant and machinery used in property business. Under the cash basis, what we saw, capital expenditure on land and building not allowed. Capital expenditure on plant and machinery, it is allowed. But coming to the accrual basis, capital allowance needs to be used, such as tools used for maintenance of property or office equipment used for running the business is not an allowed deduction from income. However, capital allowances are available. What is available? Capital allowance. What is capital allowance? Type of, it is an taxation depreciation. Taxation depreciation we'll learn further in our chapter number 8. So keep in this mind, students. Capital expenditure under cash basis for land and building not allowed. Capital expenditure for plant and machinery is allowed. Small items, what are plant and machinery? Small tools which are used to maintain the property business. When coming to the accrual business, the capital expenditure on the plant and machinery is not allowed, is not an allowed deduction, but you will be getting a capital allowance. You can claim capital allowances. Other rules like the finance cost or what how they will apply. Other rules concerning the allowed deduction, what other allowed deduction we expenditure we learned, revenue capital are same, including replacement domestic relief. The replacement domestic relief is also the same for accrual basis, and the restriction of finance or residential property operate in the same way as cash basis. When you are doing the accrual basis for residential property, the replacement relief, the finance cost relief are same, and the allowable expenditure are same. Only the difference is the impairment loss, that you need to show a different person, only you need to reduce it, because you will be showing 12 months income and then you need to reduce 1 month income. And what is the other difference? The other difference is capital expenditure on plant and machinery. Under cash basis it was completely allowable, but coming to capital, when coming to accrual basis, capital allowance will be available. So now we'll be doing a question on the accrual basis so that you have a good idea. Yeah, students, accrual basis. Accrual basis means rent receivable, expense payable will give rise to your property income. Question: X owns a property that was let out for first time on July 2023. The rent of 5,000 PA is paid quarterly in advance. X paid allowable expenses of 200 in December 2023 relating to redecoration burst pipe, and 400 pounds in May 2024 related to repair work which was completed in March 2024. Calculate X property income assuming they have elected to use the accrual basis for the tax year. This question we have already solved above, but we will be solving again so that you will be having a good grip. Only difference in accrual basis is, student, the rent receivable, expense payable. The capital expenditure for plant and machinery, you will be getting capital allowance, that you will be under cash basis, whole amount you will reduce from your income. And domestic relief will be the same, car relief will be the same, then other allowed deduction, that is insurance, repairs, everything will be same, but they must relate to that period. They must relate to that period. Then what other things? Then replacement relief, finance cost also same, allowable deduction also same, car also same. So now property income. So property income, this is accrual base. Accrual basis means for 23-24, but you are letting it on 1st July. From 1st July till 6th 5th April you need to calculate. Clear with this? 5,000 was on per annum basis, but what is the number of months? July, August, September, October, November, December, January, February, March and April. You are getting on 1st April. You will not consider it, students, because this is not cash basis, this is accrual basis. If it was cash basis you would have included cash base you would have included it, accrual basis not included, because only 9 months you will be considering. Rent received, that is 5,000 into 9 divided by 12, this will give rise to 3,750. Allowable expenses, what are the expenses that will be allowable? All the expenses same what we study, only the difference will be the, what will be the difference? Capital allowance, that will not be allowed. Capital expenditure on plant and machinery, capital allowance will be available under accrual basis. Under cash basis whole amount will be deductible. Am I right? Correct. Then but the expense must relate to that period. Which period? From July to 5th, that expense must relate to these periods. Allow expenses 200, X paid allow expense of 200 relating to redecoration of burst pipe in. So it is this 200 per burst pipe is 200. Under cash basis also it will be reduced, under accrual basis also it will be reduced. Why? This is relating to which period? November. In November burst pipe happened and it was repaired in November 2023. Now coming to the second point, the second expenses, that is Coming to the repair work. Repair work will be allowed or not, students? Under the cash basis it will not be allowed because it is paid in May, but under we are doing the accrual basis, and it was the work was completed in March only, March 24, the year is April 24, so it will be an allowed expense. So property income will be 3050. Clear with the students, the accrual basis and this? So you will not be having a confusion, I hope, in these topics, so that no issues. So no issues in these. Accrual basis and cash basis is very clear to all of them, I hope. Now we will be moving further. Only the difference is the capital expenditure on plant and machinery. Plant and machinery, you will get capital allowance here. When coming under the case of cash basis, means the whole amount will be deductible, and other replacement relief, finance cost and other are the same way, no differences. Now we will be learning the property losses. What does this topic says? Now I am having a property 1, property 2, property 3. In any one of them I do loss. Now property 1 loss I have. So what I'll do, when I do my income tax presentation, what I told you in the starting, you must combine all the property income and then you must show under your income tax calculation. So now we'll be studying. If rental income is less than the allowed expenditure, a loss arise. Yeah, now your rental income is only 100,000 and your allowed expense is 5,000. You will be getting a loss of 4,000. This line means this: your rental income is less but your allowed expenditure is more. If the landlord owns more than one property, the profit and loss of all properties are aggregated to calculate the assessable income for the year. As in a starting slide I mentioned that how you will be calculating. You will be calculating by aggregating all the income and expenses of that property. This effectively provides instant loss relief. So it will provide an instant loss relief because property 1 loss is there, but property 2, property 3 income, you will net it, you will get your net income, that will be your aggregate income, that will be presented under the income tax calculation, and on that amount you will be calculating your income tax liability. If there is an overall loss on all property, the property income assessment for the tax year will be nil. If property 1, property 2, property 3 all losses you have, minus 1000 pound, minus 500 pound, loss of minus 200, so these all are having a loss, so your property income for that year will be 0. Clear with this? And the unrelieved loss is carried forward indefinitely and is offset against the first available future property business profits. So what does this line says? Means now this year your property income is 0, but next year you will be earning income from all the property. So the losses, the property losses, now this year loss you can carry forward, means you can carry forward and set off against your future property income. How you can carry forward for unlimited time, indefinitely, no limit that you need to carry only for 10 years. No, indefinite period of time you can carry forward your loss. Current year loss can be carried for indefinite period. But how you will set off the losses? Now example, this is of the tax year of 23-24, no income. Excuse me. 24-25 you had an income of 5,000, and 25-26 you had an income of 30,000. You can't reduce this from 25-26. No, first you need to set off from 25-26, then only you can move from 25 to 10, like LIFO basis, first in first out, first in first out, like LIFO basis, first in first out. What is the first property income? You need to set off first that, then you need to move forward. So what we have learned under the property losses happens when our rental income is low but our expenses are more. If landlord owns more than 2 or 3 properties, they can net it and they'll get their aggregate income, so no issues in that. But if all the properties the landlord have losses, means then that year will be having no income, 0, but the loss can be carried forward. The loss which is carried forward can be carried for an indefinite period and needs to be set off first against the first available future profit. Clear with this? Now we'll be doing a question so that we will be having a good grip on this topic also. This topic is very important, the property loss, as you can experience or you can get a question including both the property losses, trading losses. So let's start with this, students. Now we'll not consider the name of the person, we'll be taking X only, because each of the question we have taken X only. X owns 3 property that were rented out. Her assessable income and allowed expenses for 2 years to 5th April 2000 were given. The 2 years income they have given us. Excuse me. Income for 22-23, 23-24. Property 1, property 2, property 3 they have given here. Expenses they have given. Everything they have given. So now we need to calculate X property income and loss for the tax year 22-23 and 23-24. Now we need to calculate the property income. So now property income 22-23 and property income for 23-24. So now property will be coming under the head of non-saving. So property 1, property 2, property 3. So rent, what is the income they are earning? 1200, 450, 3150. Now less expenses. What are the expenses? 1850 pounds, 600 pounds and 2800 pounds. So what will be our excuse me, sorry. Now this will give rise to our property income. Am I clear? This format would be clear to all you. So here our loss will be 650. Then property 2, our loss will be 150. And here we would be having a profit. Clear with this? But clear in mind, students, what I told. During our income tax calculation, the landlord must calculate all the income and profit together. Aggregate all the profits and losses of all the property. So if they do their total, what will be their total? 4800. The expense will be 5250. So loss of 450. Loss of 450. So our current year property income will be excuse me, student, will be 0, because don't write that a property income is 350. No. Property wise your income is for property 3 is 350, no issues. But when we do our income tax computation, when we do our income tax calculation and income tax computation, we need to take the aggregate of all the property. So when taking the aggregate of all the property, our property income will have a loss. So the current year property income will be 0, nil. So no property income in the current year. Now following the next year, excuse me, property 1, property 2 and property 3. The income will be 800, 1750 and 5100. Expenses are 900. So we have a loss. So total income will be, sorry, my bad. Here the amount was 2550. So the aggregate value will be 5100. Here property 2 has an expenses of 950. So income will be of, here we have a loss, property income or profit or loss or income. So here we'll be having an income of 800. Here we had an expense of 2700. So here also we'll be having a loss. So here our total loss will be 4550. This will give rise to a total income of 5500. Students, clear with this? So this is this year, but we had a previous year loss of 450. This we can carry This we can carry forward and set off. So less loss brought forward 450. So what is your property income for the current year? Property income for current year will be 100. Clear with this, students? Clear with this? You need to be clear with this topic. So I think the property loss is clear. As we have seen, what are the rules we have seen? If the landlord owns more than one property, they need to aggregate all the income together. If they aggregate, if they calculate and aggregate all the income, then they will be getting the total property income. That will be going under the head of tax computation. That will be going under the head of tax computation. This is effectively provides instant loss relief. Correct? Loss relief we provide instantly. But if all the property are in loss, our current year property income will be zero. But current year property losses, but the property losses can be carry forward to an undefinite period of time. Undefinite time. No limit is there. Undefinite time period, but we need to reduce the, or we need to utilize the property loss from the first available property income, that is in a FIFO basis. That next year you need to reduce, after that you can carry forward again to the next year. You can't directly jump to the leaving 1 year, and you can't directly jump. You need to set off on the first available property profits or the income which you generate from it. So I think so the session will stop at today's session here only, because the session will be too long and it will be hectic for students to study. So in today's session we have completed the property income, the cash basis, accrual basis, and the property business losses. In the cash basis we saw that is cash paid. What we have seen, cash basis means cash received, cash paid. Under the accrual, income receivable and expense payable. Under the cash basis, whatever is the amount received and whatever is the amount paid. Under the accrual basis, what is the income and expenses relating to that tax year. Clear, students? Cash basis we have done this also, and the period of to which income and expense is irrelevant in cash basis, relevant in accrual basis. Then cash basis allow expenditure. All expenditure which are generally and wholly and exclusively incurred for the property running business is allowed. But when coming to the finance cost, we have different rule. For residential property, it will be provided as a tax relief. For non-residential property, it will be reduced. The whole amount will be reduced from the property income. The pre-trading expenditure, that whatever you have incurred previously, that amount you can reduce when you are starting to let out or giving your property for rent. That what is the year limit? 7 years. We will be covering in chapter number 7 this topic. Then special rules are there for capital expenditure. Revenue expenditure is allowed, capital expenditure is not allowed, but we'll be learning the capital expenditure rule further. That is finance cost, residential property allowed, but owners who own, the owner is using his own residential property for personal use, then no tax relief will be provided. Only tax relief is provided for owner buying and letting the residential property. What is the relief? At 20%, this will be reduced from the income tax liability of the individual. This finance cost relief and the tax relief will not be available for non-residential property, qualifying FHL and companies. Further, capital expenditure. Capital expenditure for land and building are not allowed, but land and building, for both cases it is not allowed. Land and building, it is land and building under the cash basis, it is not allowed. Capital expenditure on a plant and machinery will be allowed. Those are small tools and machineries which are used for the maintenance of the property or running the business. Then general rule for car is different, and the assets which are provided in the residential property, the rules are different. That is domestic replacement, domestic relief. Capital expenditure on land and building is not allowed, but for non-residential property, the structure and building allowance is available. We'll be studying the chapter number 8. As capital expenditure on land and building is generally not allowed, it is important to distinguish between capital expenditure and revenue expenditure. Capital expenditure will be not allowed, revenue expenditure will be allowed. Capital expenditure means which increases the earning capacity of the property. Revenue means which stables or which keeps the income from the property as a as a stable. It will not increase our income. Car. So for car, what is the allowed deduction that is available? An individual has two options. Option number one is capital allowance plus actual motoring cost. Capital allowance is not available for cash basis though, but capital allowance is allowable under the, for cars it is available, because the car is an capital expenditure, it will not be allowed. But here relief is that, but here exception is that you can calculate the capital allowance under the cash basis also, plus actual motoring cost, or this you must see plus or HMRC approved mileage allowances, that is first 10,000 miles at 0.5 pounds or 45 pence, above 10,000 miles 0.25 pounds or 25 pen or 0.25 pounds or 25 pounds. From both the option, which option the individual will select? The individual will select the option which gives a higher expense, because higher expense will reduce his property income, so low income tax will be charged. Now moving to the replacement domestic relief. What does the replacement domestic relief applies to? Applies to furnitures, TV, etc., the washing machine, furniture, and does not applies to fixtures. How? What does this relief say? What is the amount that you can deduct it? Allowable deduction is replacement cost less any proceeds you have received from the original item. Because when you are providing the TV, fridge, washing machine, first time when you are letting out your property for the first time, those expenditure will not be allowed. But when your further these assets which you have provide are damaged, you will get your replacement domestic relief. What is the replacement domestic relief? Replacement cost less gross proceeds, that amount you can reduce from your property income. But one more restriction is that. What is that restriction? The replacement cost allowed is limited. It is limited to the similar standard. There should not be no improvements, but modern equivalent can be acquired. This relief does not apply to FHL and rent a room relief. We'll be studying in our next class what is rent and room relief and furnished holiday lettings. Now coming to the property income for the accrual basis. All the rules are same, but there are some differences. Some rules are different. Accrual basis means rent receivable and expense payable. Here the income and expenses of which period they are belonging are relevant, is relevant. The income and expenses of which period are they is relevant under the accrual basis. When coming to the losses, when coming to the losses, that is, I have not received the property, I have not received the rent, my tenant has ran away or is not paying. So under the cash basis, no need to do adjustment, because automatically the relief will be claimed of the impairment loss or the loss you are incurred, because whatever the amount you are received, you will be taxed according to that. So it is not received, it will not be taxed under the cash basis. But coming to accrual basis, you need to show under your expense as an impairment loss. In your examination question, it will be mentioned that there is an impairment loss. Impairment loss is an allowed expense, is an deductible expense under the property income head, because it is the accrual basis. Under the accrual basis, you will be taking the income of whole year. Now 1st January to 31st December, the whole year will be taking. So example, 6th July, 6th April to 5th April, the whole 12 months income will be showing. And if any month the tenant does not pay and did not pay and ran away, that month you will be reducing as an expense. So then the other difference was the capital expenditure relating to plant and machinery. Under the cash basis, it was allowed because those were small tools and machineries. But coming to accrual basis, you need to use the capital allowances. Now other rules concerning the allowable expenditures like replacement relief, finance cost, car, everything are same. The replacement relief, finance cost for residential property and the car, all are the same as the cash basis. Then we covered the property losses. Property losses happens when our income is greater, expenditure is low. Income is less, expenditure is more. Then an individual will aggregate all the income during his income tax calculation process, then no issues in that. But if all the properties are in loss, so then that year will not be having any property income, so no tax, so property income will be zero. But if any unrelieved loss is there, the loss of this current year can be, we can carry forward. We can carry forward and set off against first future property business profits. The loss which you are carrying forward can be carried forward for unlimited time, no limit is that, but that needs to be set off against the first property income you are receiving it. So that is LIFO basis. Clear with this? Now we will wind up our today's session. I hope the session was very interesting and I hope you enjoyed it. In our next class we'll be covering the rest three topics: FHL, the rent a room relief, and lease premium. So we'll be completing our today, as the session will be get long, so I thought that I'll be dividing into two sessions, so no issue. I hope today's class was good and you enjoyed it and you had no doubts. If you have any doubts, please do ask your queries in the comment sections also, so that I can clear in the next class. So hoping that today's session was good, you all enjoyed it. So thank you once again. We'll be continuing in our next session the same chapter. Goodbye students. Once again, thank you.